Sorry. First idea, Chevron, the giant oil and gas company.
Yes, so Chevron is one of the world's largest integrated energy companies, forecasted to gross over 225 billion US dollars in revenue for 2023. They boast about 11.3 billion barrels of proven reserves and produce about 3.1 million barrels of oil a day. Downstream operations for Chevron account for about 70%. Last month, they've reported, management reported revenue and earnings results that blew away analyst estimates. So short term, they've been on the money and doing very well. And as I said earlier, like most large cap energy companies, Chevron is really focused on returning excess cash to shareholders and keeping capital expenditures and production increases in check, thereby keeping prices pretty solid. Earlier this year also, they boosted its share buyback program to up to 15 billion US dollars of stock. Free cash flow yield is at about 10% plus, and you're getting a 3% dividend yield. You look at the technicals on this chart, it has recently broken above its long-term resistant levels. So I think that from a technical perspective, we're seeing some good signals there as well.
Okay, your next idea, Visa.
Yeah, so clearly the world's leader in digital payments, 3.7 billion credit and other payment cards in circulation across 200 countries, 32 billion US dollars in revenue expected for fiscal 2023. Last month, they actually initiated a new US dollar $12 billion share buyback program, increased their dividends by 20%. With travel and pent-up demand for travel surging, Visa is going to benefit, along with MasterCard and some of these other names. They'll benefit from more transactions in the higher margin cross-border segment. Overall, as you know, the U.S. consumer continues to be strong. We talk about the potential for slowdown and recession. I don't think the U.S. consumer got that memo because just recently we saw retail sales march to a brand new high. Visa has very good free cash flow, no material debt to speak of, forecasted to have very predictable sales and earnings growth. We've heard of the term used, the term of toll booth used for these credit card companies. And long-term, the secular trend of electronic payments will continue to grow over cash. It's only been a few years that the world has transacting more in digital payments versus cash. So therefore, there's a long runway to convert the rest of the cash over into electronic or digital payments.
And travel is a big growth area. Well, it's a big channel for them, credit card companies.
Absolutely, absolutely. And the margins for travel, when you make a transaction across the border, the margins are pretty strong for Visa and MasterCard and those companies.
Your next idea is Walt Disney, and investors are wary of the amount they're spending on content for their streaming service.
Yes, and certainly Disney has been in the news in the last few days for what I think is positive reasons. We do expect about $91 billion in expected 2023 fiscal revenues for Disney. As you know, one of the largest and most recognized media and entertainment companies. They are gaining market share in the direct-to-consumer streaming market. It's taking some time to get Disney Plus to a profitable type of area, but the old new CEO, Bob Iger, is back, so I think he'll change things around. When you combine Disney Plus with Hulu and ESPN, that's over 235 million subscribers. That is actually more than that of Netflix subscribers today. Parks and resorts segment should improve as the world kind of comes out of its lockdowns, as China eventually abandons or lessens its zero COVID approach. The studio segment looks pretty good. We've got the sequel to Avatar, which is being released in China, being released in North America. That's strong. Lots of different content along the way. The return of Bob Iger, I think, is strong. He's the one that put together Disney Plus. He's the one that bought Lucasfilms. He's the one that bought Marvel Entertainment. That could be a spark to the share price. The shares are down 50% from last year's highs. I think if you look at it from now until a couple of years later, that's very good, compelling value for a shrewd, savvy investor.
It's interesting. I'm not sure. This story just broke. Bloomberg is reporting that Amazon.com plans to spend more than $1 billion US a year on movies that will be released in theaters. Now, we've seen a move up in some of the US theater companies, AMC. Well, I guess that's kind of a meme stock, but or movie theater companies, Cinemark rallying. I'm not sure we could put up Cineplex CGX. I haven't seen it move up that much. But fascinating, the internet giants have generally held off from putting movies into theaters. They want us to watch them online.
Well, I think Amazon is sort of following the approach that Alibaba is doing in China, which is producing studio and movie content, which they have been for years. This is a way for them to diversify the revenues. And as you know, they purchased the MGM comment not too long ago, which includes James Bond and so forth. So this will probably complement what they're doing and, again, sort of give them another stream of revenue over and above their e-commerce revenue and their growing cloud business as well. So not overly surprising, interesting news for certain, but not overly surprising that they're moving into that space. The fact that they're not just releasing it for Amazon Prime is a little bit of a surprise, but it looks like they're looking to release 12 films on an annual basis into the cinema. So, you know, something for us to do now that we're hopefully out of the lockdown phase.
Of course, they spent just bazillions of dollars on this new Lord of the Rings TV series. I don't see the point of that. I thought those movies had covered off those books, but no accounting for taste.
I think it's just really creating that content and creating that ecosystem whereby you're on Prime, therefore you're on Prime Video, and so forth.
According to Bloomberg, U.S. movie ticket sales are down more than 33% from 2019, the pre-pandemic. So I guess the movie theaters will welcome any new content.
Absolutely. And they need that. They need that to draw the crowds back in.